Hello guys. Oh, I'm supposed to turn on my lights, but you all can still see me. Alright, so this video is going to be bringing everything together. Alright, market structure, identifying the trends, then looking for the right spots, to take your trade, waiting for the entry, to waiting for price to now retest, and then you take your trade, right? But now, what would you be looking for to take that trade? I'm going to do that in a minute, and I think Bitcoin is giving me an opportunity to actually teach this, right? So, um, yeah, that's what I'll do. But then I'm actually going to do some quite complex stuff that is going to be talked about in our next video, and that's supply and demand. Okay, but I'm just going to put everything we've learned so far together in this video. All right, now this is BTC USD. Okay, so when the market breaks, so I was talking about break of structure initially, right? So I'm just going to do that here so I don't mess with my charts. So this is a bearish trend. Okay, lower low, lower high, lower low, lower high, lower low, and for, okay, let me leave this like this. I'm going to make this red because this is a bearish market, and I'm going to increase so I'll just say okay, and I'm gonna increase the thickness of the line. All right, so now every time price in a bearish market, this is a, we call it a strong high because it was strong enough to break the previous low, right? So strong enough, so it's a strong high. So a strong high breaks below, creates a weak low because this low is too weak, it couldn't break above this point, so it's a weak low, and then it goes up and creates another high. Well, how strong is this high? Is it strong or is it weak? You can't tell until price from that high breaks this low. So we term this to be a strong high. So we have strong highs in a bearish market and strong lows in a bullish market. Okay, so at this point, price now, for whatever reason, from this point it went up. It's supposed to create another strong high to continue the bearish trend, but just because it was strong enough at this point, it came up, did this. Okay, oh, this is not even okay, it still works. Did this, and I'm gonna make this 2 times. All right, it did this. So what happens here is this high is no longer a strong high. Okay, sorry, it's still a strong high, but market broke structure here, and because market broke structure, this low becomes a strong low because it's the low that broke structure. So when market breaks structure like this, what are we expecting? A retracement. It's just that a retracement is basically that so the market pushes with so much force, and then it just takes a breather, it just rests, and then price just naturally comes down for a while and then picks up momentum at some point and shoots up again. Okay, so that's what a retracement is. So this is, so it retraces, right, and then pushes up. So you can see the market has changed what trend. It's no longer trending downward, it's now trending upward, and this was the market told us this was what it was going to do when it broke structure. Okay, so what this means is that I told you selling pressure is as a result of sellers. At every point in the market, the buyers and the sellers are always competing, like they're always struggling. So if the sellers are dominating, that means price is going to be falling because they are applying pressure from the top. Okay, so they'll be selling the market, shorting the market. While if the sellers are not strong enough, the buyers are going to dominate, and that means they will be, longing the market. That's applying pressure from below. All right, and what you want to do is just observe the market, see what the market is doing, and then get on the flow. Okay, you don't want to trade against those people because they're trading with really serious money, so they have that much power to influence the market, how the market moves. All right, so when the market breaks structure like this, it goes up and then it comes down. Now you want to know what point you're going to take this trade, right? That's when you now start observing, analyzing the candles. And I was going to talk about this in our next video, but I'm just going to talk about it now. But this brings us to the concept of supply and demand. All right, supply and demand. Okay, so I'll be talking about supply and demand together with other blocks. All right, so everyone who did, if you did economics, if you studied economics at some point, you would be familiar with these two words, supply and demand, and we know these are the major, most significant movers of price. So the theory states that when supply is high and that supply surpasses demand, price is going to fall. While when demand is high and that demand surpasses supply, price is going to rise. So the more something is in layman terms, the more something is in demand, the higher the price gets. Let me use a diamond for instance. A diamond is highly sought after, right? It's of no the only practical use I think a diamond is for, other than aesthetics, is just it has the ability to cut through whatever. Okay, but how often do we need to cut through hard stuff? In everyday life, I don't think the only thing I need to cut with is a knife. I mean, cut food, cut. If you're going to cut the grasses around your house, you just need something sharp. You don't need something as strong as a diamond, right? But the price of the diamond is so high because it's rare. First of all, it's very rare, and it's I mean, aesthetically it's pleasing, okay, but it's of no practical use to the everyday man, right? But just because so many people want a diamond and it's not enough to go around, the price is very, very high, right? So that the demand surpasses the supply. It's not enough to go around, but a lot of people want it, so the price goes high. That's the same thing with luxury goods. A lot of people want it, but very few people can get it. That's why the price goes up, right? So it's the same thing with supply. On the other hand, okay, let me use another instance. Something like water, for instance. We all know water is very, very, very important. We need it to survive. Like all our chemical processes in our body rely on water at some point. Okay, and physiologically, if you're thirsty, you start getting uneasy, you start feeling some type of way. All right, but so that means water is very, very important. Okay, but because it's now limited, the demand, because the supply is so much compared to the demand, price is now very low. You can find water anywhere. You can go out, even inside your gutters, you get water. Worst case scenario, you take water from your gutter and boil it and evaporate and filter and all of that, and then you get clean drinkable water. So just because it's everywhere, it's abundant, the price is very low. So that's a typical case of supply being more than demand, and that drops price. So this is the same thing with the forex market. Whenever there's a demand for something higher than the supply, price is going to go up. So naturally, that just means you're going to find demand at the bottom. So that's where price comes into, and then it shoots up. Let me change this to this, right? While you find supply at the top. And I'm going to show you how you're going to identify that on the charts next. All right, so whenever price gets to supply, it's bound to fall. Whenever price gets to demand, it's bound to rise. Now what now matters is how far will price go when it's bouncing off supply, and how far will price go when it's bouncing off demand. And it's simple. Price will always seek demand that is fresh, meaning price will always seek supply and demand that is fresh, meaning it has not been touched. It's almost like whenever price comes into a demand zone, taps into that demand zone, it's more like it saps energy from it. So just see demand zones as filling stations, gas stations, where you're going on a very long trip, but you have to always make occasional stops to refill your tank. So once you've filled your tank, you no longer need that filling station anymore, right? You just want to keep going forward. So when you get to the next filling station, that's when you refill your tank again. All right, so you're not going to just sit down there, in that gas station because you've gotten fuel. You're not going to just stay there and wait for when next you're going to get fuel from it, because you actually would not need to get fuel if you already have a full tank and you've not used what you have. All right, so this is just the analogy I can come up with off the top of my head. So I'm just going to take you guys to the charts and I'm going to show you what it's like. All right, once again, candlesticks are the language of the market, and it's the candles that are going to tell you if this is a supply or not. All right, let me use this is Bitcoin. Okay, so generally These are two candlesticks. Oops. This is a blue candle. I'm gonna fill it up with blue. And these ears are, so imagine, red candle. Yeah. This is a red candle. Fill it with red. So this is bearish. And we know they will all, where the bearish candle stops is where the bullish candle starts. And we'll see how all of this coincides with bullish engulfings and bearish engulfings. So whenever price finds a low, which is a support like we talked about before, a strong support, and it bounces off, if it just casually just moves away from price, it's just going to be an ordinary candle, like nothing significant happening there. Although there's some points where you start making analysis based on the volume. So a small candle could actually have a lot of volume, but it's not going to show up on the charts yet. All right, because what they call people who actually move the market, which is not a certain, it's not a particular person, but like a representation of, it's a collective. People who move the market are actually moving the market based on, like, they can't show you all the cards they have up their sleeves, so they have to be strategic. All right, so whenever the market moves, bullish engulfing like this, engulfs a previous candle, you see a retest before market goes up. But sometimes there's so much momentum in the candles that it shoots away, it just shoots away from the previous candle, and then you get something like this. So that entire zone is your supply zone, okay, because the market is so imbalanced at this point that price has to come back down to it. So it's your demand zone. Okay, it's your demand zone, not your supply zone. So it's your demand zone. So price has to always come back to it. And when next price, let me clone this. When next price comes down to it, it reacts instantly and then just shoots away. To continue. So it's more like it came back to get gas, like we talked about before, like I talked about before. Came back to get gas, so it's just going to shoot away. Right, that's a demand zone. Price came to demand, and because it came to demand, price is definitely bound to rise. I told you this axis represents price, right, from low to high. So price is definitely bound to go up. Okay, so in the same vein, you have supply at the top here, where you have market conditions like this. I'm just gonna reduce this and take this here. Boom. Price shoots away from, this becomes your demand, your supply zone. Supply. This becomes a supply zone because price shot away from it pretty aggressively. So what is price going to do? It's going to have to come back to it to get gas, or fuel to go down. Okay, like we talked, like I said before, this is a bearish engulfing pattern. So this is why after a bearish engulfing, you get price retracing or retesting that area, because most likely that bearish engulfing, for a candle to break above the other candle, that means there's a lot of momentum, and that momentum leaves an imbalance in the market, right, marking that zone off as either supply or demand. So that's why price will always come back to it. Okay, so this is how it happens in the market. All right, so I'm just gonna clear this out and show you what it's like on the charts. Okay.